Hello friends. Today is December 21st, 2025, and it's a great time to talk about your money. You might have noticed that the Indian rupee has been on a slow and steady journey downward against the US dollar. As of now, $1 costs around 85 rupees. This isn't a sudden crash, but a gentle slide. Think of it like a car slowly rolling down a very slight slope. This gradual weakening is not necessarily a cause for panic, but it is something every investor, big or small, should understand. It affects everything from the cost of your next foreign trip to the price of petrol and even the electronics you buy. Understanding this trend is the first step to making smarter financial decisions for the future. So, why is our rupee getting weaker? The biggest reason is the strength of the US dollar itself. When the American economy does well and its central bank, the Federal Reserve, keeps interest rates high, global investors flock to the dollar. It becomes a magnet for money, pulling capital away from other currencies, including ours. Another factor is capital outflow. Foreign investors sometimes pull their money out of the Indian stock market, and when they sell their Indian assets, they convert rupees back into dollars, creating more demand for dollars and weakening the rupee. Lastly, global uncertainty, like geopolitical tensions or worries about a worldwide economic slowdown, makes investors seek safety in the US dollar, which is seen as a stable global currency. Now, let's talk about something we all love: gold. Gold prices in India are currently shining very brightly, hovering around 75,000 rupees per 10 grams. Why so high? A big part of the answer lies in the very same rupee-dollar equation we just discussed. India imports most of its gold, and these purchases are made in US dollars. So, when the rupee weakens against the dollar, we have to pay more rupees for the same amount of gold. This is a direct impact, pushing local gold prices up, even if international prices remain stable. It's like buying an imported chocolate. If the dollar gets more expensive, the chocolate's price in rupees also goes up. Looking ahead, this trend might continue. If the rupee continues its gentle decline towards 86 or 87 against the dollar in 2026, and global demand for gold remains strong due to economic uncertainty, the price of gold in India could climb even higher. Central banks around the world are also buying gold in large quantities to diversify their reserves, which adds to the global demand. For Indian households, gold is not just an investment, but also a cultural and financial security blanket. This deep-rooted emotional connection ensures that local demand remains robust, providing a strong floor for gold prices, regardless of minor fluctuations in the market. As we look towards 2026, the global economic picture looks like a mixed bag of opportunities and challenges. Major economies like the US and Europe are expected to see slow but positive growth, perhaps around 1 to 2%. Emerging economies, including our own India, are set to be the engines of global growth, with projections suggesting a healthier growth rate of over 6%. However, this growth isn't guaranteed and comes with its own set of conditions. The world is still dealing with the after-effects of high inflation from previous years, and central banks are being very cautious. They are trying to balance controlling inflation without accidentally pushing their economies into a recession, which is a very tricky tightrope walk. Inflation is the word on every economist's lips. While the crazy price hikes of 2022 and 2023 have cooled down, inflation is expected to remain stubbornly above the ideal 2% target in many Western countries. This means interest rates might stay higher for longer than we initially thought. High interest rates make borrowing money more expensive for both companies and individuals, which can slow down economic activity. For India, this has a direct impact. It influences capital flows and puts pressure on the Reserve Bank of India to manage its own interest rate policies carefully to control inflation at home while still encouraging economic growth. This combination of slow growth and persistent inflation creates a perfect storm for market volatility. What does volatility mean? It means the stock market could see sharp swings up and down without a clear direction. Geopolitical risks, such as ongoing conflicts or trade disputes between major countries, add another layer of unpredictability. These events can disrupt supply chains, cause sudden spikes in oil prices, and make investors nervous. In such an environment, markets react strongly to news, and investor sentiment can change in the blink of an eye. This isn't a time for panic, but a time for careful planning and a steady hand. For you, the investor, this means the journey in 2026 might be a bit of a roller coaster ride. The days of easy, straight-line gains in the market are likely behind us for now. Instead, we are entering a phase where a well-thought-out strategy is more important than ever. The economic outlook suggests that there will be opportunities, especially in growth markets like India, but they will be accompanied by risks. Being aware of these potential headwinds, slow global growth, sticky inflation, and market volatility, is crucial. It allows you to set realistic expectations and build a resilient investment portfolio that can weather the inevitable ups and downs of the market cycle. In these uncertain times, investors typically turn to three main asset classes: equity, gold, and debt. Each plays a very different role in your portfolio. Equity, which means owning a small piece of a company, is the engine of wealth creation. When you invest in the stocks of good companies, you are betting on their future growth. Over the long term, equities have historically provided the highest returns, outperforming all other asset classes. They are your best bet to beat inflation and build significant wealth. However, this potential for high returns comes with higher risk and short-term volatility, as we've seen. On the other end of the spectrum is gold. Gold is often called a safe haven asset. It doesn't generate any income like a stock or a bond, but it holds its value, especially when everything else seems to be going wrong. During times of economic uncertainty, high inflation, or a weakening currency, investors rush to gold for safety. As we discussed, a weaker rupee makes gold more expensive in India, which can protect your purchasing power. Think of gold as the insurance policy in your investment portfolio. It might not give you spectacular returns every year, but it provides stability and shines brightest when other assets are struggling. In the middle, we have debt instruments. These are essentially loans you give to the government or a corporation, for which they pay you a fixed interest. Examples include public provident fund, corporate bonds, and even your simple bank fixed deposit. Debt is all about stability and predictable income. The returns are lower than what you might expect from equities, but the risk is also significantly lower. For investors who are risk-averse or need a regular fixed income stream, debt is an essential component. It acts as the anchor for your portfolio, providing a cushion against the wild swings of the stock market and ensuring a part of your capital is always safe and growing steadily. The key to successful investing, especially in a complex environment like the one we anticipate in 2026, is not to choose one of these, but to create a smart mix of all three. This is called asset allocation. A balanced portfolio with a mix of equity for growth, gold for safety, and debt for stability is the most sensible approach. The right mix depends on your age, financial goals, and how much risk you are comfortable taking. A young investor might have more in equities, while someone nearing retirement might prefer more debt. There is no one-size-fits-all answer, but the principle of diversification remains universal. Don't put all your eggs in one basket. If you are a young investor just starting your journey, the current economic climate might seem intimidating, but I want to tell you that this is actually a fantastic time to begin. Your biggest advantage is time. With a long investment horizon of 20, 30, or even 40 years, the short-term market volatility we've talked about becomes little more than noise. Your first step should be to define your financial goals. Are you saving for a down payment on a house, your future child's education, or your retirement? Having clear goals will help you stay focused and disciplined, preventing you from making emotional decisions based on daily market news. When choosing between equity, gold, and debt, your personal risk tolerance is key. How would you feel if your investment portfolio dropped by 20% in a year? If the thought makes you lose sleep, you might want to have a larger allocation to debt and gold. If you understand that market downturns are temporary and see them as buying opportunities, you can afford to take more risk with a higher allocation to equities. A good starting point for a young, balanced investor could be a mix of 60% in equities, preferably through SIPs in mutual funds, 30% in debt instruments, and 10% in gold for diversification. This is just a guideline. You must adjust it to your own comfort level. The most powerful tool for a young investor is the Systematic Investment Plan, or SIP. By investing a fixed amount of money in mutual funds every month, you practice disciplined investing and benefit from a concept called Rupee cost averaging. When the market is down, your fixed investment buys more units, and when the market is up, it buys fewer. Over time, this averages out your purchase cost and reduces the risk of trying to time the market, which is something even professionals find nearly impossible to do. An SIP in a diversified equity mutual fund is perhaps the simplest and most effective way to start building long-term wealth. In conclusion, let's tie everything together. The rupee may continue its gentle decline, which could keep gold prices firm. The global economy faces a period of slower growth and volatility. In this scenario, don't try to be a hero and make big, risky bets. Instead, be a disciplined and patient investor. Build a diversified portfolio across equities, debt, and gold that suits your goals and risk profile. Use the power of SIPs to invest regularly and harness the magic of compounding over the long term. Remember, successful investing is not about finding the next hot tip. It's about having a sound plan and sticking to it through thick and thin. Start today, stay consistent, and your future self will thank you.